It's Saturday afternoon. You're at the dealership, just looking. You didn't plan to buy anything today. Your current car still runs, mostly fine, but that new model, it's clean, shiny, smells like ambition. The salesperson walks over. Friendly, calm, professional. You deserve something reliable, he says. And with your credit, this is easy. You sit inside. Touchscreen dashboard, heated seats, smooth steering wheel. You imagine yourself driving it to work Monday. He slides a paper across the desk. It's only $689 a month. Only. Not $48,000, not $52,000 after interest, not 6 years of payments, just $689. You hesitate. Then you think, I work hard. I can afford $689. Fast forward 14 months. The excitement is gone. The payment is not. Insurance went up. Gas costs more. Registration wasn't cheap. And suddenly you realize you didn't just buy a car, you bought a monthly obligation. And that's the car payment trap nobody talks about. Let's unpack it. The trap isn't the car. Let's be clear. Cars aren't evil. They're tools. Transportation is necessary. The trap isn't owning a car. The trap is normalizing large, long-term payments for something that constantly loses value. In 2026, car payments have quietly become one of the biggest monthly expenses in many households. $600, $750, $900, even $1,100 per month. That's not rare anymore. That's normal, and that's the problem. The payment mindset trick. Dealerships don't sell cars, they sell payments. Notice how the conversation rarely starts with, this vehicle costs $52,400. It starts with, what monthly payment are you comfortable with? That shifts your brain. Instead of thinking about total cost, you think about manageability. And manageability feels smaller. $700 doesn't feel like $50,000, but over 6 to 7 years, it absolutely is. The lifestyle inflation effect. Here's how it sneaks up on you. You get a raise. You're doing better. You think, I don't want to drive that old thing anymore. So you upgrade. Not because you need to, but because you've earned it. And maybe you have. But here's the math most people don't calculate. If you invest $700 a month instead of financing a car, at 8% over 7 years, that's tens of thousands of dollars, possibly over $70,000 depending on growth. Instead, that money goes into a depreciating machine, one that loses value every year. The depreciation reality. The moment you drive off the lot, the car drops in value, not slightly, significantly. Yet your loan balance barely moves at first, so you're upside down, owing more than it's worth, for years. That's financial quicksand. You don't feel it immediately, but it limits flexibility. The hidden costs nobody mentions. The payment isn't the full story. Newer, more expensive cars mean higher insurance premiums, higher property taxes in some states, higher registration fees, more expensive repairs, premium gas in some cases. So that $700 payment, it's really $900 plus impact monthly, and that's before opportunity cost. The opportunity cost is the real killer, which is why it's dangerous. Let's say someone makes $85,000 per year. They commit to an $800 monthly car payment. That's $9,600 after tax. That might represent 15 to 20% of their take-home pay on transportation alone. Imagine redirecting that into investments, paying off a mortgage faster, building a business, financial freedom. Over a decade, that's life-changing money. But because it's wrapped in leather seats and Bluetooth, it feels harmless. The social pressure factor. Let's be honest, cars are emotional. They signal success, they signal status. People notice them. And in a world where image travels fast, that matters more than we admit. You pull up somewhere in a new car, it feels good, but here's the uncomfortable truth. Most people forget what you drive within 10 seconds. You're carrying a 6-year payment for a 10-second impression. The golden handcuffs effect. A big car payment doesn't just cost money. It costs freedom. You hesitate to switch jobs, take a pay cut for better work, start something new, move to a lower paying but more fulfilling role, because now you need that income level. The car dictates your minimum lifestyle. It becomes a quiet boss, and you don't even notice. The psychological lock-in. After a year or two, something else happens. You justify it. Well, I already committed. I deserve it. It's almost paid off. But almost paid off often means 4 more years. And by the time it's done, the cycle starts again. Because now you're used to that level. And dealerships are very good at making upgrades feel natural. The normalization problem. The biggest reason this trap works? It's normal. Everyone has payments. Your coworkers do. Your neighbors do. Your friends do. So it doesn't feel reckless. It feels standard. But standard doesn't mean smart. It just means common. The alternative nobody markets. Here's what doesn't get advertised. Buying slightly used. Driving cars longer. Paying cash when possible, choosing reliability over flash. There are no commercials for keep your paid off car. There are no ads saying invest instead, because restraint doesn't generate profit. Payments do. Does this mean never finance? Not necessarily. Sometimes financing makes sense. Reliable transportation matters. Safety matters. But the key question is this payment expanding my freedom or shrinking it? If the payment creates stress, limits options, or consumes too much income, it's a trap. A simple test. Here's a powerful one. If you lost your job tomorrow, would your car payment feel manageable or terrifying? That answer tells you everything. The long-term view. Imagine two people over 15 years. Person A upgrades cars every 5 to 6 years with $800 payments. Person B buys reliable used cars and invests the difference. 15 years later, Person A has driven nice cars. Person B might have 6 figures invested. That's not about judgment. It's about trajectory. Small monthly decisions compound. Final reflection. The car payment trap isn't obvious. It doesn't look reckless. It looks responsible. It looks adult. It looks successful. But under the surface, it often shrinks flexibility, delays wealth, increases pressure, and normalizes long-term debt. Cars are tools. They should serve your life, not control it. So next time you hear, it's only $689 a month, pause. Don't ask, can I afford this payment? Ask, what is this payment costing my future? Because freedom isn't about what you drive, it's about what you don't owe. And sometimes the most powerful financial move is driving something that's fully yours.